Recyclico, making lithium-ion last forever. Recyclico's patented recycling process achieves up to 100% recovery of battery metals from lithium-ion batteries for electric vehicles, including cobalt, lithium, nickel, manganese, and aluminum. Recyclico Battery Materials Incorporated trades on the TSX Venture AMY, on the OTCQB AMYZF, and Frankfurt ID4. For more information, visit recyclicode.com or phone us at 778-574-4444. Recyclico, making lithium-ion last forever.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is David Skarica, founder of Stock Chart of the Day online at addictedtoprofits.net. He's speaking to us from the Bahamas. Dave, it's been a while. Welcome back to HowStreet.com radio.
It's great. Yeah, it's been a while. A lot of things have happened in the world. I can't remember the last time I was on, but obviously we have COVID. We've had a bull market, a bear market, another bull market, and then we've had this bust here recently in the last, few weeks.
How are things at Addicted to Profits, and how can our listeners subscribe to your newsletter?
Well, actually, I've changed, even though I still have addictedtoprofits.net, that's where I'm posting everything. It would just refer you to my news site anyhow. I decided last year to change Addicted to Profits to Stock Chart of the Day because I was kind of done writing a newsletter, and I think that everything is moving more media orientated, like we're doing right now. Podcasts, streams, etc. So I Stock Chart of the Day. I usually do like a daily free video on my YouTube page. So that's youtube.com/Scott that's circle A, Scott Day. And then, patreon.com/Stock Chart of the Day. That's where you can sign up for the pay letter where I give, stock recommendations, and it's only $7 a month, for that. And it's $1,000 for, a lifetime subscription, and I have additional updates for lifetime subscribers as well. So, and then we do private placement, all that sort of thing as well. So Addicted to Profits has basically become Stock Chart of the Day. I'm going to keep Addicted to Profits as like a consulting business because, I live offshore in the Bahamas, and a lot of people want to move offshore to get away from taxes and that sort of thing. So I think I'm going to be kind of, because, I know how to, set up that kind of thing. So someone can do it, especially in the Bahamas. And, so I think I'm going to keep that as a business and that right. But so now it's Stock Chart of the Day, like I said. So, but again, if you go to addictedtoprofits.net, all the updates are there. And then when I do finally move it to stockchartoftheday.com, addictedtoprofits.net will just redirect you to that site anyhow. So it's great because you can see, if you go to my Stock Chart of the Day the page on YouTube, you'll see all my updates there. I've done some really interesting stuff the last few days on this market bust, talking about the Japanese yen carry trade, what it means for the market, talking about how the VIX had that huge spike on Monday, and I talk about the historical analysis behind it. I show the charts. And the great thing is it doesn't take too much of your time. Like if you're a busy person, like most of these videos tend to be 5 to 15 minutes, mostly in the 5 to 10 minute range. So you can kind of get up in the morning, eat your breakfast, watch it on your phone while you're eating your Cheerios or cornflakes or whatever you eat for breakfast, or eggs and bacon, and then you can watch what I'm saying, and it won't take too much of out of your day.
The markets got slammed earlier this week. What is the VIX showing us, and what has it shown us historically?
Well, what I think was really interesting about that market slam was, I had been doing, again, if you look at these old videos I've been doing this spring, when the market started going straight up from last fall into this spring, I started getting very worried. And there's a number of reasons. One reason was, if you go look at something called they call it the Buffett indicator, because Warren Buffett's one of his favorite indicators. It's just market cap to GDP. So market cap to GDP went to 200%. So basically the market was twice the size as the economy. And that was an all-time high only made in late 2021. And then in 2022, we had a bear market where the S&P dropped 25%. So, and you could make a more of an argument for market cap to GDP being that high in late 2021. And the reason for that is because, rates were zero. So you could say, well, people had no, other place to put their money, but now rates are 5%. So for the market cap to GDP to be that high again was, very scary. So I've been kind of warning that, and I thought it was going to be like, maybe 1987 or 1929, and because if you look at those two scenarios, that the market bottomed, in the summer to fall of the previous year, then basically went straight up into the following summer and then crashed, in October. Well, that didn't happen. This time we've had this kind of whack a little earlier. So I've been very, very much about warning about what the market could do because of this. So the VIX. This is what tells me, though, something different's happening now. The VIX spiked to 65 on Monday, and there's only been 3 times in the last 25 years the VIX has gone to that level. That was 2008 during the financial crisis and 2020 during the COVID crash. So, and both those times, of course, ended up being basically lows for the market, which moved, significantly higher. But oftentimes, too, there's at the beginning of bear markets, like April of 2000 or August of 2001, you can see these spikes in the VIX, and then you can see, or February of 2018 would be another one. And then you can see the spike, the sell-off, and then the market rallies and then begins the bear market. That's kind of the scenario I see us in now. But with the VIX having that huge spike in the short to intermediate term, I think the Fed is going to be a little more aggressive in cutting rates now. I think the market can come back, and work off that oversold level. And then at some point begin maybe a bear market later this year or early next year. The only other scenario I would warn about was, again, going back to 87 and 29. This is an amazing coincidence no one ever talks about, I think about myself, is that both those crashes happened exactly 55 days after the market topped. Not trading days, but actually total days. And no one talks about that. So if you look at 55 days, it would be September the 7th, which is the Saturday, which means September 9th would be the Monday. So I guess if we saw a kind of a counter rally here that starts to fade in early September, I would be very, very, worried that maybe that sort of scenario would happen. And obviously, if nothing crashed by September the 9th, then we're probably in this longer term topping process, which is probably going to be more the case, in my opinion, because I think they're going to do whatever they can to prop the market up into the election in the United States. So, and like I said, if you look at August of 2007 during the financial crisis, the market kind of broke, the VIX spiked, it fell 10-15%, just kind of like it did now, and then it rallied into October, and then it topped there, and then of course it fell over the next year. That's what I think is a more probable scenario.
Could it take a few months for the markets to shake off the downturn this week?
Yeah, another thing I did in some of these updates, I showed what happens when you get these VIX spikes. It happened, and some of these, especially these summer declines. A summer decline happened in August of 2011 and August of 2015. So usually what happens is about a month of backing and filling, and rallying and falling and this and that, and then the market kind of rallies slowly afterwards. So that's kind of what I see unfolding here. Probably August is going to continue to be pretty volatile, and look, unless the Fed comes to the rescue with an intermediate rate cut, which I don't think they will. I just think they'll cut a half a point in September now instead of a quarter. And I think they have waited too long. If you go look at if the 10-year Treasury is yielding 3.80 and the Fed funds rate is 5.25, there's a problem. That's a very inverted yield curve, and they should be probably probably. And by the way, I was super hawkish in 2022 when inflation started to take off. I was like, the Fed should almost increase rates to 3-4% overnight when they were 0, and because inflation was taking off so fast. And now I feel that they should probably cut rates by 100 to 200 basis points overnight, because obviously the economy is slowing and the whatnot. And the whole thing with inflation right now, I don't think it matters. It just, we're going to have inflation. The problem is debts are too high, and they have to print and spend money, or at least they have to print money because of all the money that has been spent. So we're not going to avoid it. So you might as well just cut rates now, and by cutting rates, you'll decrease the amount of interest expenditure the government has to make, because that has exploded for both the United States and Canada and every Western country in the last few years. So you might as well just, you're going to have inflation no matter what, I think, going forward. So you might as well just cut rates now to get in line to what the market is telling you. So, like you said, it could take a few months here to bottom. If you see that probably will mean that the next rally will be a little more sustainable. But again, the market cap to GDP is still, 180% after this correction, which is, other than 2021, would be an all-time high. So we're not, by no ways are equities cheap when compared to the size of the economy. And this whole thing with the Magnificent Seven, they're like, it's like the Nifty 50 back in the 70s, or all those tech stocks in the late 90s, early 2000s. It really is like a massive bubble in those stocks.
How are the U.S. stock markets looking now?
Well, we've seen this kind of rebound in the market. See, here's another interesting thing about the sell-off. One thing I was warning about, and again, I don't want to act like I'm the smartest guy in the world, and I'm talking about something that no one else is talking about, but one thing that I thought was kind of interesting about this whole bubble was that the Dow Theory, which is a theory that says that transports have to confirm what the industrials are doing. The transports peaked in 2021, during that boom of 2020 and 2021 after COVID. And I said boom in the markets, even if it wasn't a boom in the real economy. And the transports have never gone above the 2021 highs. So I told people this is still a Dow Theory sell signal. This is very worrisome, because the transports are the real economy, right? That's trains, planes, automobiles, like the old movie. And it's like things moving in the real economy. And they're not confirming what the industrials are doing. That's a worrisome sign. It happened in 99, 2000. It's happened in other bear markets. And like I said, the transports never confirmed a new all-time high. And then boom, we had this huge sell-off. So I think that in the short term, though, like I said, with the VIX where it is, we're probably seeing, I think this is more of a unwinding of a trade that will continue to unwind. And so we're going to see up and down days and volatility. For example, the major part of this is the Japanese yen carry trade. So it's not really about the U.S. economy weakening, because when I started seeing the markets really getting hit last week after the Fed decision, I was like, what's really going on here? And I don't think it's because, the economy, the jobs numbers were a little weaker than expected, but it was nothing out of the ordinary. And then I saw what the yen was doing, because the yen had been falling all year. And then it was having this large rally, and then the Japanese central bank raised rates and then had this huge spike. And people do this trade where they borrow in yen, because yen is the cheapest currency in the world to borrow in, because Japan, because of their high debt load, cannot raise interest rates. So you can borrow at under 1% there, and then you can speculate in tech stocks, commodities, emerging markets, whatever you want to, speculate in around the world with the borrowed money from Japan. So, and then what basically occurred is, when Japan raised rates, which was a surprise to some people, what has happened is all of a sudden people can't borrow that cheap yen, and they have to sell those assets and then buy back, or whatever, pay back their loan, which means that buy yen. And I think the unwinding of that kind of risk-on yen trade is why we're seeing the sell-off. And what's interesting is that happened in February of 2007. The yen had a similar rally. The market had a similar decline. Now, granted, stocks did go up until July of 2007 before they began, and then again, the yen again began to rally. But what I'm trying to say is that February 2007, that was the first crack showed up in the market, for the next, 2 years essentially. And I think this is similar. So even if the market were to rally in the short to intermediate term, maybe even go to a new high, I think that this decline is starting to show the cracks. And then at some point we'll have a more major decline. And there's one thing I'd like to say, on this, just quickly. Gold has held up pretty well. I know it's come off a bit, but I think gold shows that it's still kind of a hedge, because during this whole period, gold has really not, fallen that much. It's hanging around 2,400. And Bitcoin, you saw, got killed and went down to 50,000. Now, I'm not anti-Bitcoin at all. I think Bitcoin is a good way to speculate. The Bitcoin is just that. It's a speculation. It's a risk-on asset. It trades with the NASDAQ. It's not some currency hedge. It's not a currency. It's not a play against the valuation. So I think people should be wary of that. 2018, when the market dropped 20%, Bitcoin dropped 80%. So if we do see some kind of big downturn in the market, I would expect gold to hold up, and I expect Bitcoin to tank with the NASDAQ and risk-on asset.
The U.S. dollar also had a spike down. How has the U.S. dollar done previously when the VIX spiked higher?
I think that has to do with that because one of the aspects of the U.S. dollar one of the currencies is the yen. So I think that big rally in the yen had more to do with it. Like if you look at the Canadian dollar has barely even budged higher against the U.S. dollar during this. The euro's gone up a little bit, the pound's gone up a little bit, but really I think it has a lot to do with the yen. Like I said, this unwinding of the trade rather than fundamental weakness in the U.S. dollars. Now, with that said, if the U.S. begins to, say, cut rates more aggressively, I will think you'll see an increasing devaluation in the U.S. dollar, kind of like when they cut rates to zero from 2009 to 2011. I think you could see the U.S. dollar beginning to fall against these other currencies. But for now, I would say this has more to do with the rally in the yen rather than anything else. And I know I'm Canadian, you're Canadian, you live in Vancouver. I don't live in Canada anymore, but I think the issue with the Canadian dollar is still the current prime minister, and he's so anti-business and anti-investment. The Canadian dollar will continue to lag like this until he's gone. And then hopefully it will change because the Canadian dollar did have a high correlation with the price of oil, which now disappeared because, again, the current administration there is so anti the oil industry. So I think that once that occurs, and the one thing I will say in fairness to the conservatives in Canada, they are, unlike the Republicans in the U.S., they are fiscally conservative. Harper had balanced budgets. So I think that if Poilievre gets back in, you'll see this kind of correlation where the dollar may trade more with oil. Canada will probably get its fiscal house in line before the U.S. because the Republicans there's that old, they say the Democrats tax and spend, the Republicans borrow and spend. So I think that will really help the dollar, but that's a year and a half away. That's probably next fall as the election's going to happen. So I don't have much optimism in the Canadian dollar until Mr. Trudeau is gone, basically. So, but anyway, with the U.S. dollar, like I said, I think it has more to do with the yen rally than any really fundamental weakness in the U.S. dollars. But again, if they do start to cut rates aggressively in the U.S., I do think you will see the U.S. dollar begin to weaken against the other currencies.
What caused the Japanese yen to explode higher?
Well, what happened was the Japanese yen was going to 34 years lows. People may say, oh, Japan's a huge export economy. They have cars, electronics, etc. That's great for them. But the problem is Japan has no resources. So the steel, gold, silver, nickel, copper, etc. you need for those cars, for those industrial things that they export, they have to import. So that cost it makes them more expensive. So so with the yen dropping like that, of course the yen dropping would also increase inflation there. The central bank there knew they had to defend the yen. So and of course trades get one-sided. When the yen went to a 34-year low, people were like, okay, well this can't go anything but lower. So people probably shorting the yen on top of doing the carry trade, etc. So then the Japanese central bank, to everyone's surprise, decided to raise interest rates at a time when U.S., Europe, everyone's talking about cutting interest rates. So that caused kind of the short covering rally. And then they got people that were doing the yen carry trade had to, basically cover that. So on top of the rally caused by higher rates, you had the short covering. And of course, the Japanese stock market got whacked because they have so many export oriented, companies that were benefiting from the lower yen. So I really think it's a combination of trying to defend the currency and the unwinding of that trade. And obviously, because if you look at these U.S. tech stocks and the Magnificent Seven and what they've done, they're so leveraged. They're so leveraged. It's I think this this unwinding got, and like I said, the market went straight up basically since last fall. I think the correction was very vicious. But look, it's not a huge. Everyone's acting like whatever, it's huge, and because the VIX spiked, and the market barely and the S&P went down 10%. It's not like that big of a deal. It's not like the market crashed like 40, 50% like it did in 2008, or even 30% like it did in 2020. So it's just really a small correction. So, but I do think it's the start of the cracks in the system. And I did buy some stocks on Monday when I saw that big spike, but I don't know if these are going to be short-term trades or long-term holds at this point, because the VIX at over 60 is usually a good long-term trade, but I also think that crack might have been the start of something to the downside, but it may not happen, like the real downside may not happen for a while. Because like I said, the yen carry trade started to crack in 2007 in February, and the market didn't crash till October of 2008.
Could Japanese markets be in trouble?
Well, here's the thing about Japanese markets. In 2014, I wrote an article in something called Financial Intelligence Report, which is actually through Newsmax, which I write for. And anyhow, and I talked about how I think it's a great time to buy Japanese stocks, because the Nikkei is 14,000. The all-time high was 40,000. Japanese stocks are down almost like 70% from the all-time high, just for inflation, even higher, because the high had happened 25 years earlier, and the Nikkei went back to that high of 40,000. But a lot of it was just because if you look at the Japanese central bank's balance sheet, they just printed money and bought assets, and the Nikkei traded along with that. So I don't know, they kind of went to a new high, and now they're coming down. But it's not just the Japanese market. Like, I think obviously the fundamentals in Japan are still not great. Their demographics are bad. It's a slow growing economy. Like, the GDP per capita in Japan is not much higher than it is here in the Bahamas, if you actually look at it, because the currency dropped so much against the U.S. dollar. They have bad fundamentals, but stock market can be a different animal. Because here's another thing, the Japanese market tanked. What happens at some point in Japan, because of all the debt they have? They do go into some kind of super hyperinflation. That's happened in Argentina. Like, go look at what the Argentinian market has done in Argentinian peso terms. It's gone up thousands and thousands of percent, and hundreds of thousands of percent, because you have hyperinflation. So with Japan, I don't know, because they could see this short-term bust, but if they have an inflationary scenario because of their debt load, the market will go higher, because markets do go higher as an inflation hedge. And I just think the problem is the Western markets as a whole, especially the U.S. market, is that we're at these really high valuation levels, and that's more the issue everywhere. So, yeah, and I'm someone who likes to buy cheap assets, so even with the 12% drop in the Nikkei on Monday, would I be buying it here? No. Like I said, I was recommending buying it when Nikkei was 14,000. It's still like 36,000 now. Like, I do not want to buy the Nikkei at these levels. So, and again, it's like, it's more of an indication of the unwinding of that carry trade in Japan, rather than anything fundamental at this point. And I'm more worried about the U.S. markets, because what's happened in the last 15 years since they've done QE and all this money printing, and you have these like dominant tech companies in the U.S., money has just flowed into the U.S. like crazy. And emerging markets, European markets, like UK market, for example, the FTSE trades at 12 times earning and yields 4%. So the UK market is cheap. The US market is not cheap. So everything is flowed into the US. And I think at some point, kind of like what happened in the 2000s when emerging markets, foreign markets kind of outperformed, I think at some point that's going to happen again here. And I think that would happen when these Magnificent Seven stocks really crack. And you can already see it, like Google lost an antitrust case. I don't know if you know, it's not one of the Magnificent Seven, but SMCI, which is one of the big kind of AI plays, they had terrible earnings and tanked. So the stock was like $1,200. Now it's like $500. So just a few months ago it was $1,200. So I think that once these kind of bubbles burst, things will get a little more interesting. And we didn't really have this in our interview sheet, but like the market I still like longer term, and I buy a little more of it every time it goes down another 10%, is India. Because India is growing much quickly than China right now. They have better demographics than China. And I think India is going to be like the leading economy in the world. Vietnam is good, by the way. But like over the next 20 to 30 years, it's a long-term macro play to me. And the Indian market every 10 to 15 years tends to drop 50 to 60%. So I want to keep averaging down if that occurs. And the specific fund I'm buying, the IFN, the Indian fund, yields over 9% as well. So I just like it dropped from 21 to about 17. So I bought a low position there, and if it dropped to 14, I buy more. Dropped to 10, I'll buy more. So I would consider. I believe that India is kind of where the U.S. and the U.K. were in the 19th century. They're now in their industrial technological revolution, and they're going to continue to grow for a long time.
We'll have more with David Skarica right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with David Skarica. David, the Bank of Canada has cut interest rates twice so far this year, each time by 1/4 point. Does it look like the Fed will start cutting interest rates in the U.S.?
Yeah, I mentioned that. I think, like, unless this sell-off gets really out of control, or like one thing about that Japanese yen carry trade that we talked about, if some big hedge fund or somebody's going to blow up because of this, and it could like lead to something else. Maybe they will do emergency rate cut, but I don't see an emergency rate cut right now. What I would see is at the next meeting, the Fed will cut a 1/2 point instead of 1/4, and they may cut another 1/2 in November. So instead of just there being 50 basis points, like people were anticipating, there could be 100 basis points. So, and then that's when I think the U.S. dollar will weaken, because they're going to be cutting more aggressively. Like, one problem the Canadian dollar has right now, on top of like the terrible policies by the current administration, is, Canada kind of had to cut because, you look at real estate prices in Canada, they're much higher than the U.S. And the most popular mortgage in Canada is a 5-year fixed. And, most people did that in 2020 and 2021 when rates were very cheap. Well, that's all coming due next year in 2026. So I think the Central Bank in Canada knows they have to start cutting rates, because people can't afford basically to refinance these mortgages with these high real estate prices, because really prices haven't come down, but rates have gone way up. Like, for example, let's say you owned $1 million house. Well, when rates were 2% or 3% on that 5-year fixed, you're paying $25,000 a year. Well, now those are like 7%. So you're going to pay $70,000 a year. You're going to pay an extra $50,000 a year in interest, and most average working class, middle class Canadians cannot afford that. So I think the Central Bank in Canada knows that they have to cut because of that. But I see the U.S. kind of catching up to them. So the answer is the U.S. is definitely going to start cutting. It's just a question of, if there is another drop in the market, does that push their hand to cut more aggressively and do an inter-meeting cut? Kind of like they did in 2020 or 1998, or these things, or do they just cut larger at the next two meetings?
Do interest rates tend to move higher in waves?
Yes. So here's the interesting, even though I'm talking about cutting rates and rates going down shorter term, I think we have started a secular bull market interest rates, or bear market in bonds. We went from essentially 0 in interest rates in 2020 to 5% now. And if you go look at the super long-term chart, and again, if you go look at my stock chart of the day on YouTube, you'll see I talked about this. You'll see that we went from essentially almost 20% interest rates back in 1980, 1981 to 0 40 years later. And there were spikes like in 1985, 1984, 1987. There were like times when interest rates went up during that long-term cycle, right? And same thing when rates went up from the late 40s to the to the early 80s. There were times in like the mid 60s and 74 to 76, rates went down. So I think we're in a cyclical move where rates will probably go down for the next year or two, partly because of the weakness in the economy, et cetera. But then when they start printing money, when the deficit explodes again, I think, rates will move higher. So what I would expect is that I think around 3% is a good goal, that the Fed funds, which is 5.5%, will go to about 3% in the States on this cycle, and then begin to move higher again as inflation kind of increases when they cut rates and print money in this next cycle. So right now, yeah, I think we're in a long-term up cycle. I think this is going to be the first book I ever got interested in the markets, or interested in me in the markets, was something called Bankruptcy in 1995 by Harry E. Piggy, and he talked about the problems of the national debt. And I always tell people it's probably bankruptcy 2025. He was just 30 years too early, and he talked about at that time the problems of the debt and this sort of thing. So I think that we're going to have a sovereign debt crisis, and that will mean like higher rates, and they're going to have to print money to buy the debt and monetize all the debt, and that will lead to higher inflation as well. Because one thing you have to understand is it's kind of complicated, because when you see that the debt to GDP is 120% in the U.S., what you have to understand is about 20% of that, or 16% of it, so 20 of that 120 is owned by the Federal Reserve. So that interest goes right back to the Treasury. So if let's say debt to GDP goes to 300%, but the Federal Reserve owns 2/3 of it, because they have to print all this money, you're going to have higher rates and higher inflation. But here's what's going to happen: that interest is going to go right back to the Treasury. So the U.S. is only really going to be paying, interest on 1/3 of that debt. But that's what they're going to have to do ultimately, because the debt is just so out of control, and they can do it for the short term because the U.S. is a reserve currency. Like the U.K. had a debt to GDP of over 150% from after World War I to the end of World War II because they were the reserve currency. They could stay in that. And at that time, remember, there wasn't all these investment opportunities in the world then. It was basically back then you were investing in the U.K. or investing in the U.S., right? Like it was just like there was no emerging markets. There was none of this sort of thing. So the UK kind of like sucked up the world's capital because they were kind of also keeping the world, after World War II after World War I into World War II, stable because they did have this gigantic empire and whatnot. So, but these, like I said, these things go in cycles, and I think right now we just started the up cycle in 2020, 2021 in interest rates. And I think we're going to have a short-term down cycle for the next year or so. And then the up cycle will begin again. So, and I really believe this is finally it. Like, this is the thing I've been worried about. I'm 46 years old, and it's a weird thing to be worried about when you were 16. So I used to read all this stuff, but this is the thing I've been worried about for 30 years. And it's gone on way longer than I ever thought it could. But I do think that the next cycle, you're going to see interest rates go higher after this move down to 3%, and these governments around the world are going to have lots of problems. I actually think that you go look what's happening in Argentina. Argentina is like everybody's future. Like, they've been socialist for years. The government spent too much money. They're corrupt. And then Milei had to come in, and now he's gutting everything. And I think that's what's ultimately going to happen. And if we can go speak politically just for a second, the only person that even talks about the national debt in the U.S. is Kennedy. I saw his speech after the shooting attempt on Trump, and that was one of the first things he talked about. That this is like the biggest threat to our really our freedom and prosperity is the national debt. And Democrats and Republicans do not talk about that. It's like, when you're that rich and you're that powerful, you think it's going to last forever. The Romans thought that. The British thought that. Americans think that now. So, but I really believe we're in this upward cycle. But luckily, in the next year or two, we should see a cyclical downward cycle, and then we're going to go much higher in interest rates. And look, it's not going to be pleasant because people are dependent. In Canada, you have your national health care. In the U.S., you have Medicaid and Medicare and Social Security. These things are going to be in jeopardy because the government debt is so high. Interest payments on the debt are now in the U.S. more than the military expenditure. And here, just quickly to go on, I'm going a little segue here, but this relates to long-term interest rate cycles. Right now, the U.S. spends about $7 trillion a year, and they take in $5 trillion in revenue. So the deficit is $2 trillion. Well, $5 trillion is what Medicaid, Medicare, Social Security, interest, and military are. So you could cut the rest of the government to zero, and that would balance the budget. But you have to cut the rest of it to absolute zero. And because those other $5 trillion are basically set in stone. So what's going to happen when there's a recession and that $2 trillion deficit, and they're running a $2 trillion deficit, 7% of GDP during an economic expansion. Like Biden and Harris should be ashamed of themselves for doing that, So, and what's going to happen when this is a recession? This deficit's going to be $3 to $4 trillion. And I think when that happens, which would probably be, I would think later next year, 2026, I think, whatever. That's when I think you could see they call them the bond vigilantes. I think that's when you could see interest rates really spike, because people will say, you're not a good investment, USA, and your debt is out of control, and we want more the payment back, and then you might be forced to really slash expenditures everywhere. But so to end that question, I know I kind of talked a little long. Is a short term, I see like the cyclical move where interest rates move lower, and then longer term, the next few years, I see them moving back higher in this long-term secular kind of trend that began in 2020. And by the way, interest rate cycles are super long, even longer than equity secular cycles. They're 30, 40 years. Like I said, the last downward move in interest rates lasted 40 years. So I'm not saying it's going to last 40 years, but this could definitely last 20 to 30 years. And it will probably be the end of the U.S. as the lone superpower of the world, especially with India emerging, the BRIC countries emerging, etc.
How have gold and silver held up so far this week?
Silver has not done very well. I was hoping that silver had a lot of resistance at $30 when it broke it. I was like, okay, we'll never see below 30 again. But like silver always does, it disappoints the bulls. So it's back down to $26, $27. And the problem with silver is it's a little more economically sensitive than gold, and it's more cyclical, it's more volatile. So it does look like it's trying to find a base in here. Gold has held up really well, if you ask me. It's 2,400. It's just kind of hanging around here. Even if it went down to 2,300, I have no problem with that. It's had a nice move higher. But here's the thing that's interesting about gold and silver. They are the top, especially the equities, are the top performing assets in the 12 to 18 months after the Federal Reserve begins a rate cut cycle. So once they begin to cut rates, whether it be an intermediate cut, in the next month, whether it be, in the next 45 days, like, a 50 basis point cut in the middle of September, I believe that they really start to outperform. Like, if you go look at, like, even the financial crisis, everything crashed from, the summer of 2008 into the fall of 2008. But that first year, from about August of 2007 to the summer of 2008, the best performing sector were gold equities. When they cut rates in an emergency rate cut in mid-August of 2007. So I would say that gold and silver are it will do very well. And I've done a historical analysis, by the way, of this, and I've shown every rate cut cycle going back 30, 40 years. And whenever the Federal Reserve begins to cut rates, even in a bull market like 1995, gold and silver perform very well in the early stages of those rate cut cycles. So I would expect that they're going to continue to do very well. And now we have this whole sovereign debt crisis thrown into that. We've got, like I said, the U.S. debt's 120%. If you take, like, Canadian debt combined with the federal and provinces, Canadian debt's about the same. And plus Canada's got all this private debt that's even higher because of the high home prices and people having these huge mortgages. So gold and silver should do very well in the next rate cut cycle, extremely well. I think this is like a super move that's going to happen. And ultimately, usually it's happened in 1980 and 1932. The bull market in gold and silver ends when essentially you have the Dow and gold meeting. Well, now the gold's 4,000, or sorry, the Dow's 40,000 and gold is 2,400. So I don't know where they're going to meet, 10,000, 20,000, 30,000. But ultimately, that's usually where it ends. So those are super long-term cycles, just so you know. Like, that's like something that happens every 70 years. but like, ultimately that will occur, in my opinion.
Due to COVID, is the stock market crash in February and March of 2020 generally ignored?
Yeah, because like, look, it wasn't a real crash, in my opinion. Like, I remember when it happened. If anyone wants to look me up and see some fun videos, I don't know if you know the website Barstool. Barstool visited me right before COVID. They're interesting videos because COVID lockdowns basically started when this guy named, he calls himself Wonton Don. Donnie Does, also his YouTube channel. So if you type in like Wonton Don Bahamas, you'll see the videos I did with him. And basically he had to leave the island because the lockdowns were starting. And they're fun videos. They're not like anything to do. We talk a little bit about my investing, but, and I have an interesting nickname on the island, which you'll find out if you watch those videos. And anyhow, but anyhow, like, I remember when it was happening, and it was just because they shut down the entire economy, global economy, so the market had to adjust to that. So the market dumped 30% in like a month. And then it came right back because then all the stimulus that came back afterward. So I don't know. I never really considered that a real crash because it was like artificially almost induced by all the restrictions and all the things that were going on due to COVID. So yeah, it was like, I consider that a sharp correction more than an actual crash. Because a crash was like, to me, is like 2008, where the economy it was terrible for years. Like, home prices didn't actually bottom in the United States until 2011, right? So, I would consider that more of like a real crash. Like, yeah, I think that's the problem with the whole COVID thing. It was so quick that people forget about it. And then with all the money they printed and dropping rates to zero, they caused this huge bubble that went on until late 2021. Especially in any stock that had to do with like, all these tech stocks did well because people were staying at home and streaming videos and doing whatever, playing games and they weren't leaving their houses. So it causes boom into like, these kind of companies that benefited from that. So, I don't know. I don't really consider that 2020 a true crash. I consider it more very sharp correction because they essentially shut down the global economy for a month.
When markets get volatile, do some hedge funds tend to blow up?
Well, I touched on the Japanese yen trade, so that's what I'm worried about right now. It's like, I don't know if you remember LTCM back in 1998. That's kind of when I was like first started my newsletter, and one of my first trades was actually buying S&P calls when I was all of like 20 years old, and because the VIX was high and there was a lot of fear and Federal Reserve was cutting interest rates, and really the U.S. economy was doing pretty well at the time, and so I didn't see it as a big meltdown. And actually, if I knew what I knew now about buying really beaten up assets, I would have been buying Russia, which was the epicenter of the bust. Russian market fell like 95% in U.S. dollar terms. So that's what I would have been buying. And actually, over the next 10 years, Russia was about the best performing market in the world. So, with volatility, you get more opportunity, and that's kind of what I see. There's a couple stocks I did buy recently that are beaten up, and then I'm just going to wait to see what they do. But the one issue we have right now, we have to be a little wary, is that we've only seen, like I said, a 10% drop in the S&P. So it's not like, some things are cheap. Like, everyone wants to just buy NVIDIA or Apple or whatever, but like those stocks or whatever, they're off like these extremely high levels. So they're not cheap at all. But I think that we're going to see continued volatility in the short term for sure. And like I said, like you said, I don't know how many, like LTCM in 1998, I don't know how many funds are that exposed to Japanese carry trade. So, and if they are, though, you could see, remember, these funds are leveraged. It's not just like they're getting lent money by Japan at 0.5% and buying the U.S. stock market, right? They're leveraging those trades 5, 10 to 1. Well, of course, if you're leveraged 10 to 1, you lose 10%, you're done. You're wiped out. That's what happened in 1929 during the crash when the market fell 40% in a few days. Well, when you 40% and people are buying with 5% margin, you're done. You've lost 8 times what you really had in the market. So that will be the issue going forward. Like, how leveraged are these funds? And, with the U.S., let's say the NASDAQ, for example, dropping 15% and the Japanese yen rallying 10%, that's basically a 25% trade against you. How leveraged is that 25%? If you're leveraged 5 to 1, you're done. You're wiped out. So that's what we have to see now going forward.
What are you seeing ahead for real estate in Canada and the U.S.?
Canada, I wouldn't touch with a 100-foot pole because it's just like it's too overvalued. It's too look. I live in the Bahamas. Like, I have different probably views than most Canadians. I am Canadian. I don't want to live in the cold. I don't want to pay taxes. So I have no clue why people would pay $3 million for a house in Vancouver, $2 million for a place in Toronto, right? So, I know there's an influx of immigrants, and that's definitely propping up the prices. And Canada is still viewed as a stable country and all this sort of thing. So, but Canada, I just don't see any upside. If you're not someone who's obsessed with their healthcare, I would say sell in Canada and move to the Caribbean, move to, some place that's Central America, Costa Rica, someplace that's cheaper and, you could save a bunch of your money and live in a better climate, right? So I know people have families and lives and jobs and all that sort of thing, but if you're kind of a digital nomad like me, you can work from anywhere, that's what I recommend doing. So especially the major centers like Toronto and Vancouver, no way. I would even consider that. Everywhere's gone up, but if you were gonna buy in Canada, I'd be living in Montreal or something like that. Yeah, I know winters suck there, but you're gonna be paying a quarter of the price and the whatnot. And U.S. is not quite as expensive. The median price in the U.S. is $400,000, but it's still a lot. You could buy a nice house in Dallas, Texas for a couple $100,000 15 years ago. Now it's 4, 5, 600 grand. So I would stay away from all of them right now because they're all part of this cost of living thing that's going on. Now, like I said, if we have hyperinflation, housing is an asset and it tends to go up with that. So you won't lose your money on it. But I just can't see myself even here, in the Bahamas. I was telling you off air, I bought my house for $350,000 because a house down the road sold. It's very similar to my house. It's on the ocean. I'm on a hilltop, so I know my house is a little less than this. Actually sold to a guy who used to be a famous football player for the Miami Dolphins. He bought it for $1.1 million. So I'm well, if his house is 1.1, I think my house is 900 to $1 million. And I'm so my house has tripled in price in 14 years. So I wouldn't even, other than vacant lots, I wouldn't even buy here as well. So I would just stay away because we're in this, they call it the everything bubble, where housing, stocks, all asset prices have gone crazy during this 14 years of printing money and zero rates and all this sort of thing. So I would just stay away. And there's other aspects too, which I'm not going to get into here. My issue too with Canada is the issues right now you're having with freedom of speech and all those political things. So I'll be honest with you, as a Canadian, I have zero interest of ever going back to Canada, at this point, with the way things have occurred there. So I would stay away. In terms of real estate, I just think you got to look for places that still have value. There's a lot of places in Spain or Italy that are very cheap. You can still get, and I would look at that rather than you can buy a town in Italy for $1 if you want to help fix up some of it. So North America, I would just kind of stay away right now. Now that doesn't go for everywhere. There's certain places. And just quickly to go to U.S. real estate, U.S. is interesting because you have these places like the blue states or California and New York where people are leaving, and then you have the red states where Texas, South Carolina, Florida, where people are moving to. So it's I think the U.S. is going to be this weird dichotomy where some of these states are going to do very well and boom, and then some of these states are going to really struggle, And as a Canadian, okay, if you move to Ohio's weather is no different from Ontario. and you'll buy a house for a quarter of the price that you would have in Ontario, right? So why not do that? You know, you go to Buffalo. I know Buffalo is not the greatest place in the world. No offense. But the real estate prices in Buffalo are a quarter what they are in Toronto, right? And it's really not that big of a difference in terms of weather, et cetera, right? So those are things people can consider, but I think most people live in their little bubbles and they don't want to really move and take chances or whatever. And like I said, I know that people have family. Like I'm a bachelor, so like it's easy for me to talk this, but people I know have wives and kids and all this stuff, which also makes things more difficult. But I will say one thing. We have a saying down here, it's better in the Bahamas, and I totally agree with that. We don't have any income tax. The weather's good. Maybe the odd hurricane. I'm trying to get my car fixed right now. It's been a pain in the butt. So stuff like that sometimes can be like difficult, but I'll put up with that stuff rather than living like in a suburb in the rat race in southern Ontario.
Are the Robin Hooders still around, and are they still called Robin Hooders?
Oh, yeah, they're like I don't know, like the meme stocks and stuff. Like, I don't know. Hey, did you see that guy, whatever his name is, the kitty guy, when he did his podcast, you know, because he's trying to pump his GameStop position? Like, he's a weirdo. Sorry, that guy is probably a drug addict too. But he like that was just like strange to me. And I don't know, the Robin Hooders were all like, that was really a 2020, 2021 thing where you had all these little, like these tech stocks pumping, you had crypto pumping, you had, you know, like you had the meme stock trades. So I don't think they were around as much. Like Robinhood, I know has rebounded a bit, the stock price, but I don't know. It's just like I just think they were just like they're very small traders who trading these ultra speculative positions. And actually, I'd like to talk about this quickly. I think this was an offshoot of the cost of living crisis, that these millennials and Gen Zers, they can't really, like I noted, they can't really afford homes. They can't afford this stuff. So what happens is they're like, okay, I'm going to put my money into, you know, I'm not even talking about Bitcoin, like some weird altcoin, and try to make 1,000 times of my money, because the only way I'm going to be able to buy a house is if I put this couple $1,000s I have and I can make $200,000 or $300,000 on that, and then use that as a down payment on a house. Because if I live in LA or New York or something, like the average price of a house is like Toronto or Vancouver. It's $1 million or $2 million, right? So I think that's like really an offshoot of the cost of living crisis. And there's also this thing where people don't want to do any fundamental research. Like one thing I've always had an issue with crypto is like, I do think they should be securities and they should have to report, because if you saw how little money these crypto coins made, they'd be trading 1/10 of what they're making, now. When I buy a company, I'm looking at the earnings, I'm looking at the revenues, I'm looking at the cash flows. No one does that with a crypto coin, you know? So, you know, it's like, you know, they had something called Cum Rocket coin. Like, it's ridiculous, you know, and they have Kamala coin and Trump coin. Like, what the hell is that? Like, there's no fundamentals behind that. You know, they're just going to shoot up and one of them win the election. It's just like, it's ridiculous. So I think it's like, it's a combination of laziness, people wanting to get rich overnight, but also this thing where like they have to almost get rich overnight because the cost of living is so high, and that's how they can pay for it, you know? So in a way, I feel sorry for some of these Gen Zers, because it's like, you know, like, yeah, like I said, we were talking off air. I don't know if I could afford my house now here in the Bahamas. Like, I make pretty good money, but it's triple the price, and interest rates are higher now than when I bought. Mostly the houses in the Bahamas are second homes that like rich people just buy now cash. They don't get mortgage. I had a mortgage. You know, I paid it off 3 years ago. So anyhow, man. So that's anyhow, like that's the way I view it. Is just that it all comes back to like, you know, the Robin Hooders are just. I think that is an offshoot of the cost of living crisis, right? And maybe that Generation 2 has some ADD problems because they're all on TikTok or whatever, and they don't want to do the real fundamental research. Like I read a recent stat that more of the population now, about 65%, is investing in stock market than ever before. So, people are obviously speculating, and the historical high used to be 40 to 50%. That's what happened in 29. That's what happened in 2000. So that's another, by the way, contrary indicator for the markets. But again, I think it's an offshoot of this cost of living crisis, and people are like, I have to make money in the markets to support a lifestyle that I potentially want, because I just can't do that working anymore because cost of living is so high. Like, just go to a grocery store. You know, who cares about what they tell you inflation is? We all know that in the last 3-4 years, inflation's way higher. I'll give you a quick story on that. Is that there's a service I use in Nassau, and I order good meats from them because, you know, here we're more about seafood, right? But I do like a good steak. And the porterhouse steak they used to sell for like $70 on the service is now $100. So it's up 40% in the last, 2 years. So that's essentially what's happened. And that's essentially why people, I think these Robin Hooders, or whatever you want to call them, are speculating. But I think that's kind of over with now. I think that GameStop guy's embarrassing stream that he did, where he looked like he was on drugs and like really like out of it. He was probably a one-trick pony. I think that kind of ended it. So, and because when you're investing in those meme stocks, you're not investing in fundamentals. You're investing in like, okay, I want this thing to go up 10x, and I want the shorts to cover,
Where can people subscribe to your newsletter?
Yeah, so like I said, I've changed it to Stock Chart of the Day. So if you go to, I have a Patreon, so it's patreon.com/Stock Chart of the Day, youtube.com/ScottDay, so that's the short form of Stock Chart of the Day, And so if you subscribe to my YouTube, I'll have the link there. And if you go to my Patreon, it's only $7 a month. I actually consider it more of a donation because, like I said, I do these daily free videos, and it's a way to keep it, free for the subscribers. So I think in a year or so, I'm going to do it more as a pay service where I'll do one free video a week, and then maybe I'll or 2 free videos a week, and then the rest of them will be paid. But for now, I'm doing the service. I'm trying to build it up. So, like I said, if you go to, I would say at this point, just sign up to my YouTube and then see if you like it, and then sign up to Patreon if you like it.
David, thank you so much for chatting with us.
Okay, thanks for having me.
My guest has been David Skarica, founder of Stock Chart of the Day online at addictedtoprofits.net. He was speaking to us from the Bahamas. If you have any questions for David or for any of our guests, you can send them to info@howstreet.com. Find us on X @HowStreet. Our YouTube channel is Talk Digital Network. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.